Hello and welcome to Currency Point, presented by me, Evan Lucas, for FP Markets. As always, please have a very good read through of the disclaimer on screen. Everything in this video is general in nature. None of it should be relied upon as any form of personal advice. FP Markets does not know your personal scenario, nor your personal financial goals, and therefore none of it should be relied upon as any form of advice at all. It's just general in nature only. Let's start with a chart, because we always love a chart, and have a look at this. I know we're talking about the Winter Olympics at the moment, but this absolutely looks like a half pipe going on down at the Winter Olympics at the moment. And it is the 2-year US bond. And it is something that I don't think most people in the market has ever seen go and move in the speed that it has. It's incredible to have a look at. And it is all around the idea of how fast rates are going to move over the next 2 years in the US. We know that, that's a given. But the chart is telling us that it's going to happen at such an incredible rate that I think it's going to be overly done if it happens that way. And I think that's the next step of this. So why is it happening? We've been talking about this for months and we know where US inflation sits. And again, in January, you cannot go past with what happened. The January figures were astounding. Once again, if you have a look, 0.6 of 1% month on month means it's up 7.5% year on year. That is the highest it's been since 1982. And that is because of food, it's because of fuel, but also then look at the core figures. Up 0.5 of 1% month on month and up 6% year on year. That means it's broad based, and we did see that. It's things like rents, it's things like housing. It is across the board that interest rates therefore are under pressure because inflation is now 4 percentage points above where the Fed wants it. And that's where we're all talking about here. It is also making things very tricky with how we trade and where things are moving at this point. Have a look at the US dollar. It absolutely rocked it on the news and then whips all about. I haven't seen that kind of volatility for several years in the US dollar particularly, and it's across the board. Look at euro dollar, what a round trip that took in terms of where it went through 113, back up through 114 to the high end, and then back down again. Have a look also at cable, through 135, through to 136, back down to where it started. Aussie dollar, it went from as high as 72 cents down to 71.5 and then back up again. It's really hard to get a gauge on it in terms of where we sit. So then you have somebody like Jamie Bullard, who is clearly a massive hawk, but he's also a voting member, talking about raising rates very, very quickly. He wants a definite 0.5 of 1% going on in the March rate, and he wants at least the federal funds rate to be at 1% before the end of the year, maybe even higher. That's a bit hard, and I think that needs to be put in here before we go any further with where we sit. Don't forget, central banks are not here to put a screaming handbrake and slow things down so fast just to control inflation. They will not want to do that. It will be slower than expected, and therefore there will be disappointment when you hear to the hawks particularly and those big bearish people that are looking for this as an absolute trigger point. It won't happen like that, but it will rise. And that's the given. We know that. The 2-year yield is telling you that. It's going to rise. It's just that it's going to take a little bit longer than the market's currently pricing in.